This is the security valuation chapter in CA Final SFM new syllabus, test your knowledge question 7, or in the old syllabus SFM, which is question 17 or maybe question 16. It differs with the edition. In the old edition it is question 17. In the new edition of old syllabus it is question 16. Anyways, it is the capital structure of SUN Limited, where we have to find the value per equity share of the company. With the new syllabus test your knowledge question, there is an addition of 1% and 2%, which is given here. It is given here as notes, as there is a 1%. Yeah, I think you can say 1% on every one-time difference of fixed interest and fixed dividend coverage, and 2% for every capital gearing ratio. This thing is given as a note. It is taken as assuming. It is taken as assuming the risk premium is worked out assuming this thing. It is as a note and as an assumption. However, in the new syllabus question, it is taken as a part of the question. So we will be considering this as well. Okay. So now this is a question which normally students find it difficult because of the various terms such as fixed interest and fixed dividend, capital gearing, yield on share, and terms like that. But it is an easy question. We'll try to solve it faster. Let's read the question for a minute. Capital structure of SUN Limited has its capital structure as under: capital equity share capital 8% preference, 12% of debentures and reserves. SUN Limited earns a profit of 32 lakhs annually on an average before deduction of income tax, which works out to be 35%, and interest on debentures. Normal return. So here it means 32 lakhs is the average before deduction of income tax and interest on debentures, which means that 32 lakhs is the profit before interest and tax, EBIT, because it's before tax and before interest, EBIT. And then we have tax of 35%. Normal return on equity shares is at 9.6%. Profit after tax covers fixed interest and fixed dividends at least 3 times. Capital gearing ratio is 0.75. Yield on share is calculated at 50% of the profits distributed and 5% of the undistributed profits. SUN Limited has been regularly paying dividend of 8%. Compute the value per equity share of the company. Now, before starting with, let's understand what is the valuation of equity shares, or what are the different methods of valuing equity shares. See, there are various methods. I hope you can see. There are various methods through which equity shares can be valued. One is the dividend based model. Second one is an earnings based model. Third is cash flow based model. Now, which is the model which we should take in this question? Here we have hints. It's hints like fixed interest and fixed dividends, capital gearing ratio, yield on share. These 3 indicate a specific model in this, which is the earnings based model. It is the earnings based model and not the dividend or the cash flow. Under the earnings, we have actual and expected yield approach, where under this approach the value of a share can be as actual yield divided by expected yield into paid up value of share. This is the formula through which we can get the answer of this question. The question asks for the value of equity share, wherein we are trying to find the value of share using this formula, which is actual yield divided by the expected yield into paid up value of share. Now let's understand what is this. What are the various formulas to actual yield and expected yield, or how do we find out? Yeah, actual yield is equal to the yield on equity shares divided by the equity share capital into 100. The yield on equity share divided by the equity share capital into 100. So what is the yield on equity shares? Now wait, before that we'll just tell what are the other formulas. Expected yield is the market return plus or minus your risk premium. Okay, market return plus or minus your risk premium. And finally we have the paid up value. The paid up value, because the question is silent, we are assuming it to be rupee 100 is the paid up value. Okay, so now let's understand what is the yield on shares. Okay, actual yield. The yield on equity share can be, the question clearly says here that the yield on share is calculated at 50% of the profits distributed and 5% of undistributed profits. Now, what is the profit? What does it mean by profits distributed? It is obviously dividend, and says that SUN Ltd has been regularly paying equity dividend at 8%, which means 50% of this 8% is the yield. Okay, 50% of the 8% is the yield plus 5% of undistributed profits, and we have to find the undistributed profits on which 5% is applied to find the yield. So okay, now 50% on 8%, on what is 8% calculated? On the equity share of 80 into 8% into 50% plus on undistributed profits 5%. So here it is equity share capital 80 into equity share capital 80 into 8% into 50%. Okay, plus on an undistributed profits we have 5%. Okay, divided by equity share capital 80 into 100. Okay, now how is this undistributed profit found? Okay, how is this undistributed profit found? We all know that undistributed profits can be found using a formula. Everyone, I think almost everyone knows it. It is like earnings before interest and tax. Okay, I'm sorry, earnings before interest and tax minus interest gives you EBT, that is earnings before tax, minus tax gives you earnings after tax, minus preference dividend gives you earnings after tax for equity shareholders. Okay, minus equity dividend gives you undistributed profit, right? So by this you can find your undistributed profits. Now EBIT is directly given in the question, which is 32 lakhs. Okay, 32 lakhs. Interest is it's given, it's 12% of debentures, which is on 64. So that is 64 into 12% is 7.68 lakhs. Okay, minus 32 gives you 24.32. Question says tax is at 35%, so we are deducting 35% from it, so it is minus 35% gives you 15.808 minus your preference dividend. It says that 8% of preference dividend on 40 lakhs, so 40 into 8% gives you 3.2. when you reduce it, it is 12.608. On it you have your equity dividend, where we found it here. It is like on 80 lakhs 8%, so 80 into 8% is 6.4. Okay, and minus 12.608 gives you 6.208 as your undistributed profits. So on these undistributed profits you have 5% to your yield, that is, it is your 6.208. okay, so we have a total now of 80 into 8% into 50% gives you 3.2 plus 6.208 into 5% gives you 0.3104 divided by 80 into 100. Okay, gives you 3.2 plus 0.3104 divided by 80 into 100. So 4.388%, 4.388% is your actual yield. Okay, now here we have found the actual yield. Now we have to find the expected yield, right? expected yield is, we know that expected yield is equal to your market return plus or minus your risk premium. Okay, now what is risk premium? Or this might be the part, or the little tricky part that people or students usually fail to answer it, but the thing is so simple, it's nothing complicated. Risk premium, to understand risk premium, we have to know what is the risk premium, or how risk premium is identified or calculated. See, we all know the concept of higher the risk, higher the return. Okay, we all know this. Higher is the risk, higher is the return. Now see, when is your return, market return is your base return, right? Market return is your base return. In order to increase your base return, okay, in order to increase your base return, what do? You have to add. Obviously you have to add. When do you add? When you have a higher return. Okay, to increase your return you have to add. When do you add? When you have a high return. Okay, and when do you add your high return? When you have a high risk, because higher the risk, higher the return. So if you need to add your return to your base return, okay, if you need to add your return to your base return, you have to have a higher risk. So if your risk increases, your return increases. If your return increases, you can add so that it can increase your whole return. So that is how risk premium is calculated. Okay, so here hence it simply means that your risk premium means the extent to which your base return, can increase or decrease based on the risk. The extent to which your base return can increase or decrease to the extent of the risk. So higher the risk, higher is the return. So if there is higher return, you can add. Now, is this risk premium calculated? Okay, the risk premium, calculation of the risk premium. Okay, calculation of risk premium. In order to calculate the risk premium, we need various ratios such as fixed interest, fixed dividend coverage ratio, or interest coverage ratio, or maybe capital gearing ratio. See, now this question has capital gearing ratio of 0.75, fixed interest and fixed dividend ratio of 3. These are industry ratios. That is, the industry ratios are fixed interest, fixed interest and dividend coverage ratio, which is equal to 3. Okay, capital gearing ratio, which is equal to 0.75. But these are of the industry. What do we need? We need SUN Limited's fixed interest and dividend coverage ratio. Okay, what is it? It is the formula to it is profit after tax, okay, plus debenture interest, profit after tax plus debenture interest divided by debenture interest plus preference dividend. Okay, profit after tax plus debenture interest divided by debenture interest plus preference dividend. What does this mean? This means it defines the extent of profit that is required to cover the interest. See, when is debenture interest given, or when is preference dividend given? See, from this we know that preference dividend is given from earnings after tax. From earnings or profit after tax or earnings after tax, preference dividend is given. So the extent to which the profit after tax is required to cover your preference dividend, the extent to which your profit after tax is required to cover your preference dividend is this ratio. Or in case of EBIT, in order to cover, you need EBIT, not EBIT, basically your PAT plus your interest. Okay, your PAT plus your interest to cover your interest. Similarly, your profit plus your debenture interest to cover your debenture interest, and the profit after tax to cover your preference dividend. So the extent to which the profit is required to cover your debenture interest and your preference dividend, this is being found out from this ratio. So now with this we can find what is your profit after tax. It's 15.808 plus your debenture interest is 7.68. okay, 7.68 divided by 7.68 plus your preference dividend is 3.2. okay, 3.2. So from this we can find 15.808, okay, plus 7.68 gives you 23.488 divided by 7.68 plus 3.2 gives you 10.88, gives you 23.488 divided by 10.88 is 2.16 times. So it is 2, we divided it and we got 2.16 times. So what does it mean? It means that the profit, profit requires the profit takes 2.16 times to cover its debenture, interest and preference dividend. Okay, so now it means that higher the risk, the ratio to risk, ratio of return to risk, the ratio to risk is here is higher the ratio, lower the risk. So higher the ratio, lower is the risk. Now the question is, we have 2.16 of SUN Ltd here. However, the industry was 3. The industry had 3. See, had it been 3, since higher the ratio, lower the risk. Had it been 3, it would have been covered so much of risk. But here it is only 2.16. I hope you understand this. Had it been 3, the profit could have covered more of debenture, interest and preference. However, here it is only 2.16, so the coverage is less. So higher the ratio, lower the risk. Since we have a lower ratio, the risk is higher. Since we have a lower ratio compared to 3, lower is the ratio, higher is the risk. So to the extent of 3 minus 2.16, that is 3 minus 2.16, we have 0.84 is the addition in risk. Since it is a lower return, it is a lower ratio times than 3, we have a higher risk. So 0.84 times will be added. This will be added as risk premium to our initial risk premium. This will be added. In similar way, we found what is fixed interest, fixed dividend. Similar way, what is capital gearing ratio, which is given in the question. Capital gearing ratio, the formula to it is fixed interest bearing funds, okay, divided by equity share funds. Now what does this mean? This ratio means that, okay, to what extent of the equity share funds are the fixed interest bearing funds? To what extent of the equity share funds are the fixed interest bearing funds? Okay, what are fixed interest bearing funds? Fixed interest bearing funds are preference share capital plus debentures. Okay, preference share capital and debentures have fixed return, right? Preference share capital and debentures have fixed return, whereas equity share funds such as equity share capital plus reserves and surplus are normal equity share funds. So what is the extent to which the fixed interest bearing funds have on equity share funds? This is the meaning to this. Now okay, let's find what is it. It's preference share capital, which is preference share capital is 40 plus debentures is 64. So we have 40 plus 64, okay, divided by equity share capital is 80 plus reserves is 32. Equity share capital is 80 plus reserves is 32, 60. Yeah, so we have 40 plus 64, it's 104, divided by 80 plus 32, we have 112. So 104 divided by 112 equals 0.93 times. Okay, so it is 0.93 times. However, compared to the benchmark of the industry, it is only 0.75. Means when the industry had 0.75, SUN Ltd has 0.93, which means that SUN Ltd is more riskier. Hence 0.93 minus 0.75, which is 0.93 minus 0.75 gives you 0.18 times. 0.18 times SUN Ltd is more risky, means you have to add this again with your risk premium. Okay, so here we'll add 0.84 because it's more risky. 0.84 to the extent of 0.84, it is more risky than industry. 0.18 since it is more risky. we'll add this to with the risk as the risk premium with the market return. We had this market return here, we'll add here. However, in this question, in the test your knowledge question as well, they have an addition. They have an addition telling that there is a difference of interest. There is 1% for every 1 time of difference for fixed interest fixed dividend coverage ratio, 2% for every 1 time of difference for capital gearing ratio. See, this is an assumption in all syllabus question. This is assuming that the solution has been, the risk premium has been worked out as such, as by assuming 1% and 2% for the ratios. However, it could be assumed that there is nothing like this in the old syllabus. However, in the new syllabus question, it is specifically given in the question as such. So which means that you have to include this 1% on the difference, on the found difference for the risk premium for fixed interest fixed dividend coverage, and 2% for the capital gearing ratio. So what do? Eventually you multiply 1, that is 1 on your found out ratio, difference ratio, and 2% on the capital gearing found out ratio. So here it is on the 1% on your fixed interest fixed dividend, that is here it is into 1, it makes no difference, which is 0.84 again. Okay, however, in the question it says it is 2% here, it is 2% for capital gearing ratio, so it will be into 2, which means it is 0.36 times, right? So it will be 0.36 times, and here it will be 0.84. So we are adding it for the expected yield. Now the expected yield will be your market return. Okay, your market return is given in the question, which is given, it is 9.6. It is given in the question directly, 9.6. Market return is 9.6 plus 0.84 for your fixed interest, and 0.36 for your capital gearing ratio. So it is, it is 0.84 plus 0.36. So you get 9.6 plus 0.84 plus 0.36, you get 10.8 as your expected yield. Now you got your actual yield in the question. Before it was 4.388. Okay, you got your expected yield. Now what you need to find is your value of share. Now value of share is actual yield divided by the expected yield into paid up value of share, which we assume it to be 100 rupees. So we get value of share, which is your actual yield, which is 4.388 divided by expected yield, which is 10.8, into rupee 100 of paid up value. We get 4.388 divided by 10.8 into 100. We get rupee 40.63. 40.63 is the final value of it. We can just check with the answer. It is 40.65 due to decimal differences. So this is the answer to your question. It was simple. I hope you liked it and understood. Thank you so much. Thank you for watching.